Hey Axia members, welcome. This is June. Okay, happy June, and this is Brannigan Barrett, and this is the stream for Tuesday, the 2nd of June. Let's get straight into it, as usual, our objectives. And today we're going to discuss three different principles. Okay, and so last week we kind of spoke about auction imbalances on the footprint. Now we're going to take a little bit of a step further forward, and we're going to continue this discussion on auction imbalances. Except today we're going to introduce it onto a both a candlestick chart as well as the market profile, and we're going to move on to a confluence play with regards to these auction imbalances. Okay, so this is where we're going today. We're going to start off with three principles, three sort of words that we throw around quite a lot as traders. You often hear people talking about it. But the important question to take away from today, and hopefully the question you can answer by the end of the session, is what exactly is volume? What exactly are insignificant narratives, and what are low volume areas? Okay, that's kind of where I want to go today. I want to go to these three areas. I'm going to show you little practical examples in hope that you then go away and you develop your understanding around these three sort of concepts, principles. Okay, that's what this entire stream is about. It's always about a principle. Okay, one of the things, unfortunately, that too many traders look for is they look for a precise understanding. Unfortunately, it doesn't exist in trading. Okay, precision is not something you should ever search for in terms of an understanding, because it's a very nuanced job we do. Right? In some instances, high volume means one thing. In other instances, it means the complete opposite. Okay, take for example, you could have high volume at the end of a significant trend up move. Okay, in which case it turns, rolls over, and that's the top for many years. But equally, you could have a high volume move that keeps going and going and going. Okay, different contexts, ultimately different outcomes. Okay, so that's why you never ever marry to a specific rule. High volume doesn't necessarily mean only one thing. Okay, within different contexts, high volume and low volume can mean certain things. Okay, so this is where we're going to go with it. We're going to start off with volume. Okay, we're then going to move to insignificant narratives and then finish with low volume areas and use a nice practical example in the German 10-year Bund. Now, we're going to start off with volume. Right? The first thing to understand with regards to volume is ultimately these three things. One, price, positioning, and volatility. Now, as a basic rule of thumb, okay, volume effectively is activity. It's transactional flow. It's how much physical trade is taking place between buyers and sellers. Okay. Now, if you were just to think about that, right, for a second, you'll come to the realization that volume in isolation as a variable is probably something quite important to understand. Okay, because if volume is ultimately the trade between buyers and sellers, understanding what that trade is telling us, whether it's high amount of trade or a low amount of trade, is crucially important in understanding potential opportunities. Okay, the problem comes in is that we can't just look at volume in isolation. We need to look at volume plus price. Okay, is there high volume and is price going up, or is there high volume and price going down? Vice versa, is there low volume and price is going up, or is there low volume and price is going down? Okay. What about positioning? Does high volume with a trend-like move ultimately tell us there's new positioning in the market, or does it tell us there's an unwinding of positioning? Okay. And the last part, volatility. Right? A common mistake is people associate high volume with high volatility. Okay, it's not necessarily the case. Sometimes you can have volatile markets, in other words, very little liquidity, in other words, price range is wide on low volume. Sometimes you can have volatility on high volume. Okay. Now I'm going to give you three basic rules of thumb. Basic rules of thumb. Okay. As we go through this, and I want you just to think about them and go and research it further. Don't take what I say as God's truth. Okay. And it doesn't exist in trading, unfortunately. Okay. So let's get into it and let's get to a practical example. Okay. Where we're going to go with this today is we're actually going to go on to the daily charts, because this is where it's best to explain different nuances. And I'm going to start with the oil market. Okay, And what we're looking at, I'm going to want to cast your eyes onto this wonderful red bar charts. Okay. Now what we can see very clearly is that oil on the dailies has rallied from whatever that low is, $12 all the way up to $36. Okay, relatively straight line. We can all agree that that's a relatively strong trending up move. Okay, but what's happened to volume on a day-to-day basis? Well, the best way to depict this is to get either a very short-term moving average, which is this turquoise, which is a 5-day moving average, or get a slightly longer moving average, which is a 21-day moving average. Okay. The important takeaway from both of it is note how steep the decline is. Okay, it's a really, really strong, decline in the trend of volume over the course of the last month and a bit. Okay, what does that mean? What does that mean to me as a trader? What is the importance of that? Okay, now like I said, in isolation, decreasing volume doesn't mean much to me. Okay, but what about decreasing volume in a market that's trending upward? Okay, now as a basic rule of thumb, a market that is trending upward on decreasing volume has a higher probability of retracing that trend at some point in the future. Okay, in other words, I'm not saying we're going to go back down to $12 a barrel. What I'm saying is at some point this market will run into a pool of liquidity. In other words, right now this market's in price discovery mode. Okay, at the moment it's moving higher and higher and higher, and very clearly as it's moving higher, there is no one offering the market. There's no one providing liquidity as a seller. That is why it keeps moving higher and higher in terms of price on low volume. Okay, the moment that market finds liquidity and the volume picks up, you will then see the market start to offer. You'll see the volume start to increase as obviously anyone long takes some profits and anyone looking to get short enters the market. In other words, eventually volume will pick back up, and the volume picking up will confirm to us a turning point in the market. Okay, let's switch that around. What happens if we were seeing this market trending on higher and higher volume? Okay, think of what that means. If the market's trending on higher and higher volume, it's telling us that buyers are very aggressively lifting relatively big offers. In other words, there are people selling the market, but there's so much buy-side interest, okay, that the sellers or the amount of selling cannot even stop all that amount of buying. All that amount of buying. Now, the good example to look at that is let's look at the ES. Okay, so obviously we had the sell-off. I just want to make this a bit smaller. So we had that sell-off in March. Okay, coronavirus, everyone wanting to get out, panic, etc., etc. Okay, now notice how the volume in this instance. Okay, we initially had that surge. Okay, everyone wanting to be short. A lot of people were providing liquidity. Okay, but equally, the market wanted to get out of those trades. So there was a lot of two-way trade taking place. And again, when I say someone providing liquidity, not necessarily just to be long. Okay, don't be very cautious. I see this mistake so often. Okay, the markets were not created for speculation. Okay, the markets were created for trade to be facilitated, so that companies could raise equity, so that companies could raise debt. There's a number of reasons for institutions to be able to execute. That's why the markets were created. They weren't created for speculation. Okay, so just because a market goes up doesn't mean that the market is positioning itself long. Okay, that's important to understand. Most people don't know that, but markets were created for anything but speculation. Okay, it's just we speculate on them. Now, markets bounced. Okay, and we can see that market bounced and the volume started to drop off. Okay, the moment that market found the sellers, what did we see? We saw the volume pick back up and the trend continue. Okay, now what this is showing us is that as price is moving, it's bringing in more and more and more participants into the play. Okay, eventually we could see that the markets found a low. We could see the volume still relatively high, and then they started to drop off. And as they started to drop off, well, as price started to rise, we started to see those volumes drop off and drift and drift and drift and drift. Okay, you can see that volumes have been relatively average for almost the last month. All right, so that's one instance in which volume, okay, can ultimately not necessarily dictate, but in which volume is being transacted based on where price is going. Okay, so let's recap. When there's trend in the market on high volume, right, as a rule of thumb, be very cautious fading it. Okay, listen carefully. When there's trend in the market on high volume, be cautious fading it. Why? Because it's telling us there's quite a lot of positioning in the market. When there's trend on low volume, as we saw in the oil, be very cautious going with it, okay, because at some point it finds that liquidity, turns back over, and starts to move in the opposite direction. Okay, so that's volume. The next part, positioning. And the ES is a good one to use here because we have two examples of it. Okay, so we can see very clearly in the high volume move, right, on a trend move, the market is starting to position itself short. Okay, the net positioning in the market is short. Okay, market bounces back, we get a continuation. Right, let's flip that around. Okay, now we can see in the oil market, for example, okay, market's moving on low and low volume as we're trending. Right, the positioning of the market, we might look at this and say, well, the positioning is long, but in actual fact, it's not long. Okay, it's just a market that's drifting higher and higher. Right, at some point this turns over and you'll see there should be a relatively easy drop off in price as the market searches for liquidity in the opposite direction. Okay, so those are basic rule of thumbs. And what I will say to you, don't take everything I say as God sent. Okay, God's truth, sorry. If you want more understanding, and this is a fantastic book called VPA, Volume Price Analysis. I don't know what the author's name is. Is it Kula or something like that? I can have a look if you urgently want to know. Just send me an email. I'll respond to that. Okay, so that's our volume analysis. Now, the next point we want to look at is just volatility, and this is where we have to be very, very cautious. Okay, you can have just one sec. You can have, we go to the pound, okay, you can have very low volume days, okay, with a very relatively high range. And we've got the perfect example, okay. On this day, you can see where my green line is. Notice we have a really wide range and very high volume. On today, which is the 1st of June, what do we have? A very wide range on very average, if not low volume. Okay, basic rule of thumb. When you have high volatility on high volume, price tends to continue in that direction. When you have a high volatility in low volume, you tend to find the market consolidates very often the next day. Okay, so don't be surprised to see on the 2nd June a little bit of an inside day, maybe even a reversal type day on Tuesday the 2nd of June. Okay, so have a look at that. Again, we can see another example here, high volume day. Okay, wide range, obviously, that's the blue there. In this instance, obviously, we had a consolidation day and we started to sell off. So again, it's not a hard, fast rule, and this is the key. There's no hard, fast rules in trading. There's only an interpretation and an understanding, and you need to be able to first and foremost interpret something, high volume, low volume, positioning, volatility, and then go and develop the understanding. Okay, but nothing is ever exact. Unfortunately, that just doesn't work in trading. Okay, now let's move on to the second part of this. Insignificant narratives. Okay, now last week was very fitting because what's happened over the course of the last week is we obviously had Hong Kong or the Chinese come out and express that they're going to impose legislation within Hong Kong. Okay, and then the US came back and said this is very naughty and it means that the special status that Hong Kong has effectively could be jeopardized. Okay, we then have Trump come out on a Thursday and say he's going to hold a press conference on a Friday. Right, and the market starts to price in something. It starts to price in, potentially tariffs, potentially, all sorts of kind of restrictions, trade war, escalation, etc., etc. Now, it's crucial that if you want to develop a fundamental understanding as a trader, you've got to know what is market moving in terms of a narrative and what isn't. Okay, because more often than not what you're going to find is that most narratives are not market moving. Okay, point in mind, lovely example. 2019 was pretty much the year of trade wars between China and the United States. Okay, where did equity markets finish the year? Record highs, up 30%. Okay, even during the times that we saw escalations where tariffs were imposed, yes, we got 3-4% pullbacks in equities, and yes, there was a bit of volatility, but the trend remained intact the entire year. Okay, at the point that ultimately we got this, China and US agreeing to a deal which was no different to what they had before the war started. Okay, the market still rallied 30%, guys. Right? And this is the important thing to do, is don't get sucked into the short-term narrative, because there's so much news in their Financial Times and Bloomberg's and Twitter's that are bombarding us with these narratives that we start to think that they are market moving, and the simple answer is they're not. Okay, so make sure you can differentiate between a significant narrative and an insignificant one. Example, okay, in Trump's press conference on Friday, the market went into that press conference short. Okay, why? Because, well, there's a good risk reward. If Trump imposes new tariffs, the equity markets drop 5%. Okay, so everyone's going short into that, including myself. Okay, Trump comes out and there's no escalation. Okay, imposes a couple of visa restrictions. Says Hong Kong, we're really upset with you, etc., etc. But ultimately, there was no worst case scenario. There was no further tariffs imposed, no walking away from the deal, nothing like that. And the market, in essence, rallied from 29.75 all the way back to where we are now, 30.50. So a good 2% rally on the back of that. Okay. In other words, the market went into it net short, yes, right? But unless Trump imposes new tariffs on China, okay, or unless Trump walks away from a trade deal, it's a insignificant narrative. Now, the important thing is, how do we know something is also an insignificant narrative? Well, we look at the markets. Okay. Now, what you've got up in front of you in this purple is the Chinese yuan. Okay. Now we can see that the currency, since we started to see that Hong Kong escalation, we can see there was a little bit of an initial depreciation in the Chinese yuan. That's that day there. Okay. There was a good sort of 1% move we saw. But what's happened since then? The market's not just retraced that, it's even retraced more. Okay, so what that tells us is, it confirms to us that the market narrative for China is, if the US was to impose new tariffs or to walk away from the trade deal, there would be market significance. There would be a market move on that. Until we get such a thing, okay, it's very, very unlikely that we see any kind of market impact with regards to China. Okay. The other thing you can look at is what we call proxy markets. Okay, so this is a direct market. Chinese yuan is directly impacted by US-China trade deal. But proxy markets, okay, this is the Aussie dollar yen. In any trade escalation, okay, Australia's biggest trade partner is obviously China. Okay. Now, what we saw going into that, did we see any kind of offer in the Aussie versus the Japanese yen over the course of the the last 5 days, when Hong Kong legislation was potentially being changed, when Trump was potentially putting tariffs? Did we see any depreciation in the Aussie dollar against the yen? Simple answer is no. If anything, the Aussie dollar rallied into it. Okay, and that's what we're talking about here. We're trying to establish what are significant narratives and what are insignificant narratives. Now, what I am going to say is that this is very much hindsight, okay, very much Harry hindsight. I was short into the Friday press conference, as was many of the Axia traders, for good reason. There was good risk reward. But what we didn't establish, and probably where we were lacking a little bit of preparation, was in this: what is a significant narrative and what is an insignificant narrative? So, the lesson going forward, when we're preparing for these potential risk events, make sure you know, number one, what is market moving, what is significant, and number two, what are you willing to trade off of? Okay, if you do that, you're well prepared. Over the long run, you're going to start to develop an edge trading these sorts of conferences. Okay, now the last part is this continuation of last week's discussion of the low volume areas and what we call imbalances in footprints. Okay, and to show you this, I'm actually going to bring up the volume profile. Okay, so what we're looking at is German Bunds. Now, I'm going to bring in a twofold approach here. I'm going to show you the volume profile, but then more importantly, I'm actually going to show you, a confluence play. Okay, so for those of you that are not familiar with profiles, we can see on the 26th of May, we had a little bit of a trend day. Okay, so market opened, that's the K print, and we pretty much sold off and formed what we call a B-shaped, a B-shaped profile. Now, B-shaped profiles show us a little bit of trend, a little bit of, strength in selling. Okay, because the market very quickly navigates away from a certain price, and then it facilitates trade lower down. Okay, so this is quite a strong hint of price action. We can see the next day, market comes back up, tests the cash high, which is that M print, and then ultimately offers lower. So we can see that the B print follows through on the next day. All right, we then have an inside day on the 28th, followed by a little bit of a break of an inside day to the upside. Now, this is a very interesting day here, because what happens on the month end 29th is we can see the market facilitates trade pretty much at the top end of that 26th of May. But very importantly, once we get to the high made on 27th, okay, around that 53, what do we get? We get a little bit of a volatility, okay, so a very volatile candle, the most volatile of the session. But look how quickly it gets rejected. Okay, it opened at 47s, but closed all the way down at 36. It's a bit of a hammer almost, or sorry, a shooting star. Okay, now this is significant because it's telling us that not only do we have a low volume area where the market's very quickly rejected price, but on the first attempt to trade back in there, it very quickly got rejected again. Okay, so that's the information. If you're coming into today on the 1st of June, you've got that information with you. You've not made money in any of this. You're just aware that the market is very aggressively positioned short from the 26th, and we've seen a second attempt which was very swiftly rejected on the 29th. Okay, so we can call this resistance now. Why? Not because Brannigan says so, but because the markets have told us that not once but twice we very swiftly rejected away from this 53s to 57 area. Okay, so market opens up today, and all of a sudden we get a nice little down day. Okay, now a lot of you are saying, oh yeah, it's not that big, but well, this is almost a point move, guys. Okay, a point move in the German Bunds right now is quite infrequent, quite rare. Okay, so from the close on Friday, we get a point move to the downside. Now, where the confluence comes in, okay, is in a pattern play we call a ledge, and you can see it right over here at 72s. Okay, I'm going to put it in green for you. Now, what a ledge is where we get a significant amount of two-way trade at a specific price. Okay, so that the market almost forms like a little bit of a cliff edge, right, where it just cannot get below, cannot get below, cannot get below. And what happened today was, okay, just for a basic, I'm not going to go over this. This is well documented in both the profiling course as well as the footprint course. When we have a ledge like this, they are what we call market imbalances. Okay, or in profiling terms, you call them market anomalies. Now, these imbalances or anomalies, at some point in time, they trade out, they correct themselves. At some point in time, not necessarily the same day, not necessarily the next day, but at some point, they trade themselves out. And that's what happened here, was we had a confluence where the market told us we needed to be short. Okay, we then got the break of this ledge to the downside today. Okay, now, if I was to show you where the execution was, we obviously had our initial move down in the cash session. It came back just before the afternoon session, gave us an entry point, towards yesterday's low volume area or Friday's low volume area, and then we had the straight line offer. Okay, relatively risk-free in the sense that 70 ticks of exposure with a stop above the futures open at 32s. Okay, so relatively tight, 12 ticks for 70 ticks, not too bad risk reward. Okay, and that's our confluence play then, from the German Bunds on the 1st of June. Okay, now what this means, let's finish, with a strong note here. What this means now is we can see this market stuck in a bit of a sideways range. Okay, I'm not saying be short, I'm not saying be long, but what I'm saying is you've got this piece of information, which is that 52s to 56 is very strong resistance. Okay, if we start to trade above 52s, you want to be aggressively buying for a fill up to the 92s. Okay, why? Because the positioning is short in the market, which means above 52s, and you should start to see the sellers unwind. Okay. Equally, so long as 52s to 56s hold, and we stay in this little bit of a range, the probability starts to increase that we're going to start to drift lower. Okay, so we short so long as this area holds, but we do want to see these sellers start to be rewarded, okay, because as much as we can say sellers rejected the 52 to 56s, we can very clearly see that the weekly low at 71.50 also got rejected today. Okay, we can see that because our C print opened, tested, and very quickly got rejected. Okay, so keep an eye on this. If 171.50 holds for a second day, right, it's very likely we're going to distribute inside today's range. If we start to see some progress made towards the downside, you should see this trend continue. Okay guys, so that's then our stream for today. 3 concepts: volume, insignificant narratives, low volume areas, and confluence. Go look into it. Alright. Any questions? Like I said, I think it's Anna Coolio, or Anna, yeah, that's the author of the book VPA, Volume Price Analysis. Go have a look at it. If you're still unsure, you don't get the right one, reach out to me. Any questions as usual? Do feel free to reach out, and otherwise, thank you. If I had an hour to solve a problem, I'd spend 55 minutes thinking about the problem, 5 minutes solving it. Good luck for the week ahead, and we'll catch up again next week.